Good afternoon and welcome to 25 Minutes with Cap, where each month we discuss recent trends in the specialty insurance space. My name is Adam Sills and I run our specialty insurance business here at CapSpecialty. Today, I'm excited to have Mr. Pat Ryan joining us, who's the founder, chairman, and CEO of Ryan Specialty Group. Mr. Ryan formed Ryan Specialty Group in 2010, and it's an international holding company specializing in wholesale brokerage, insurance underwriting managers, and other specialty services to brokers, agents, and insurers. They're also one of our top partners here at CapSpecialty. Prior to launching RSG, Mr. Ryan founded Aon Corporation, served as its chairman and CEO for 41 years. Mr. Ryan's retirement, Aon had more than 500 offices in 120 countries, generating revenues then in excess of $7 billion. And at RSG, 2021 revenue ended up 40%, up 1.4 billion. Mr. Ryan, thank you for joining us.
Thank you, Adam. I'm happy to be here.
So as we go on from here, if you have any questions through the session, feel free to enter them into the chat and we'll do our best to answer them. And just as a reminder, the content of this webinar is the property of CapSpecialty and is for informational purposes only. You're not permitted to republish, share, or quote from this webinar without the prior written consent of CapSpecialty, which can be obtained by contacting marketing@capspecialty.com. We hope you enjoyed the discussion. So, Mr. Ryan, I briefly covered this in the introduction. You had a legendary career before founding RSG, chairman and CEO of Aon for 41 years. You retired in 2008. What did you see in the wholesale market in 2010 that made you pivot to founding Ryan Specialty Group?
I'd always been interested, Adam, in the specialty lines of insurance because it allowed for innovation. And I've always liked that part of the business. I felt that the world had gotten so much riskier. It was the financial crisis, but there was all these other risks that had started to build up, climate and social change beginning and so on. And I just saw the world getting much riskier. And I thought that specialty lines were going to become much more important than they had been. And very importantly, because of this complexity of risk, scale of increasing risk, they were going to, for the most part, not at all exclusive, would find their home in the E&S market because of the freedom of rate and form. So I'd been in the wholesale business before, and certainly in the MGU business at Aon, and I like those niches. It just seemed that there was going to be a great growth trajectory because of the riskiness. But additionally, I saw some other changes that did materialize quite quickly, and that is that retailers in those days, Adam, were using pretty hundreds of wholesalers. It was quite inefficient, wasn't cost effective, but equally important, maybe more importantly, they weren't optimizing the value of their portfolio, taking it to the marketplace. It was much more fragmented. It wasn't as well thought out to be. So I thought that retailers would begin to reduce the number of wholesalers and consolidate. And sure enough, Aon started it, and they'd gone down to 10. In fact, while I was there, we'd gone down to 10. And then in early 2011, went to 3. Now, 3 preferred, and distinguish between preferred and they're not exclusive, they're preferred. And that then began a sequence that continues to this day. So smaller wholesalers were going to be losing the appointments because of the consolidation. Concurrent with all of that, Adam, was the beginning of the consolidation of retailers by some strategics, but principally by PE firms. And that force was going to build larger retail brokers, which happened really quite quickly, as we all know. So if you had a trading relationship and you were preferred with those consolidators, they in effect were helping you build your clientele by buying up the retail brokerage segment. And so that really accelerated dramatically. The additional factor that I anticipated, and it materialized even more quickly, was that through the consolidation of carriers that went on, frankly, in the 90s and then in the early part of this century, a lot of underwriters were disaffected through consolidation. Now, maybe they didn't lose their position, but friends did. And so there was increasing mobility. And I saw that increasing mobility as people looking for different kinds of opportunities. And I thought that with this focus on specialization, expanding as it was, that MGUs, or delegated authority, was going to take on even greater importance. Now, delegated authority had been around a long time, as you know.
Sure.
But I saw it as expanding in programs, discrete programs for either product or industry specialization, or both, binding authorities, ever more valuable as a distribution source and managing underwriting facilities, but then discrete managing underwriters that were not binding in nature. They were full-scale authority on a delegated basis. So all of those were coming together, and I really felt that was going to accelerate the growth potential, and it certainly has.
To your point, so much of the focus has been on building and acquiring programs and binding authorities. For us, we focus on retaining and driving our own underwriting decisions, but I think we're in the minority here amongst insurance companies. Why do you think insurance companies haven't been more successful retaining and driving the underwriting decisions themselves?
Well, I think they have been successful. The analogy of religion and politics. People have their own perspective on it, and they're passionate about it. And there's no right or wrong. It's what's right for the individual company. And so there's great companies that have maintained their business and grown it really, really well without delegating any authority. Conversely, there are growing numbers, particularly some new capital providers, who have said, we'll delegate because we can get variable costs instead of fixed costs. So we only pay for what we write, what risks we take on, and we can get a discipline of the delegated underwriting authority where we'll be comfortable that we have, through audits and guardrails on authority, that we can have a profitable book. So that has grown significantly. And then frankly, because of specialization being so attractive and effective, where people have become real experts, program managers took on a whole new value, where a lot of the creativity, innovation has come from the distribution side. And so some innovative people said, well, I think I'll set up a program for custodians of apartment buildings. Just pick it. There's just a wide range, and you've seen many of them, and I'm sure the audience sees them all the time. But that's a growing phenomenon, and that part of the business hasn't been consolidated yet. And frankly, the binding business has not been consolidated yet. The transactional wholesale has been consolidated for sure.
As you think about, since starting the business in 2010, what's something that you would have done differently in the building of it, if anything? Would you have accelerated certain areas more than others, or not?
I retired in '08 from Aon.
Right.
I knew what I was going to do, but the mayor of the city of Chicago enticed me to chair an ill-fated attempt to get the 2016 Summer Olympics. And so I did that while still at Aon as executive chair, but then for a year and a half after that. I wasn't going to stay if we won, but we never had a chance of winning. But if we won, I wasn't going to stay with the bid. We would have hired professionals to manage that. So I was going to start what became Ryan Specialty. I would have started it earlier.
Sure. But nothing else as you look at the past 10, 12 years of, I would have wanted to focus in this certain area more, or pushed growth harder in this certain area?
Always. I mean, there's always that issue. I wish I would have discovered renewables earlier than we did. We did in 2011. I wish I would have discovered transactional liability earlier. We did that in late 2010. Cyber was just getting started. I wish we'd gotten into it earlier.
Sure.
So there's nothing that we've done that I wish we hadn't done. But I wish I would have done it earlier and more aggressively.
Sure. RSG has had a ton of organic growth success. It's also made acquisitions. How important is it to have a singular corporate culture to drive through the organization, particularly as you foster entrepreneurs through MGUs? Or is there some type of middle ground that you look at as you're bringing in new people all the time?
I think the key thing is culture is differentiating. Strategies are difficult to be differentiating because people can emulate them. Secondly, cultures should never change. They evolve with the times. For example, everybody's more focused on diversity today, rightfully so, and much later than they should have been, but that's a cultural phenomenon. But the core value culture of businesses, I think, are truly differentiating. So, I did that in the first company I started, the first Ryan Insurance, and then copied that culture in Aon, and then again in Ryan Specialty, because it's just worked really well. But I think it's fundamental, Adam, to the success of an organization, and then being consistent with the culture. So we really value our culture. We look for people that are attracted to the culture, both through individual hires. And if there's not a cultural fit on an acquisition, we won't do it. Doesn't matter what the price is. There's no price cheap enough to sacrifice the cultural fit.
You're always able to see it in the diligence process. You're always able to see it before.
We see it before. We don't get into the diligence process very often. Occasionally we get fooled, and then you'll see it in the diligence process. We've only been fooled once in terms of people we thought were the right cultural fit. And it was a small deal, but we bit the bullet right away. 6 months, within 6 months, we said, this is not working because the cultural fit's not there. So we'll sell the business back to you.
Sure.
And we did.
Sure. There's been a lot of discussion about insurtech and general automation trends. And there's been a bunch of money raised to create tech-enabled distribution, tech-enabled carriers. But insurance can be hard, and E&S insurance can be harder. Where do you think some of these companies have gotten it wrong?
Insurtechs, I think, came in, for the most part, thinking that they were going to disintermediate the agent and broker. I never believed that. I always believed This goes back into the 90s when we were consolidating so much of the industry at hand. A lot of people thought brokers would be disintermediated by technology. You remember the dot-com boom. Everybody thought that was going to be a big disintermediator. But I didn't, because the value of a broker and agent, either or, is timeless, and they bring advice that's needed by the insured, and they bring advocacy in the terms, advocacy on claims, advocacy on price. So those roles are really, really critical and timeless. And the insurtechs thought that they could disintermediate and remove that, take costs out through shortening the distribution chain. That didn't work. Now, they're all smart people, and so they did audibles quickly. And I think most of the capital is now going, particularly anything in the commercial side, is going to enable and empower the broker agent, make them more efficient, make them able to compete against larger opposition by giving them access to sophisticated technology. So there's a lot of good work being done there. And so, we're developing technology, as everybody is, but it's to get the data analytics capability, but it's also to help that broker agent reduce their operating costs and be more efficient so they can compete.
So you see it when you talk about data and analytics, really to make better and quicker underwriting decisions.
Yeah, I'd say better first, quicker. Right. Some people define quicker, everybody defines quicker differently, but I never thought that the underwriting decisions that are too slow obviously cost you the business. Underwriting decisions that are too slow get you adverse selection, because the risk is still around waiting for to get your good in there. If it's still there waiting for you, you're probably getting a bad risk. So, I think it's really the quality of the underwriting that we should look for.
One of the questions we got in here was, how do you see climate change affecting different lines of coverage and opportunities to capitalize on this phenomenon?
Well, climate change is clearly an issue for the world. It's clearly an issue for insurers and insureds. And therefore, innovation is required in terms of access to the capital. One of the biggest problems in climate change risks today is that they can be so huge, carriers have to take shorter limits, have to have caps. And so we're finding that a consortium of capital is a better solution, so that you can divide up these more volatile risks into thinner slices, and so that people get a lot of volume and they get some diversity of exposures, geographic and other, and so that they can get a spread of risk. That's the essence of the insurance industry principles. So I think that what's happened is that people like us and others are the demand is that we bring more capital, more access to capital for climate change risks. And that's not easy, because there are a lot of people walking away from it and some running away from it. But it's a challenge for the industry, but it has to be solved. You have to solve those problems.
Sure. So one of the questions we had also come in, and this is a riff on a question we had before of, so the market, you've had a hard market, an extremely hard market in certain coverage areas over the last couple of years. Rates are firming. You hear people talk about rates continuing to firm. What do you see as the future of the market here? Do you see more pain coming in, rates that just need to increase?
Well, for sure, there are certain lines of business where rates need to increase. Cyber is certainly a classic.
Sure.
Healthcare. There are lots of risks that are still getting rate increases, significant rate increases. Cyber, property cat, as I said, healthcare.
Sure.
But there's a lot of pressures out there in terms of costs that are going to be emerging. And so I think you're seeing people be more cautious, because inflation can be a beneficiary to our industry, but it's also can be a huge negative. So a lot of these risks were priced at a lower inflation rate, and the claims are going to be paid out at a higher inflation rate. And that's problematic in terms of reserve development. So there's just a lot of risk development that is different than the past because of the chaos with the war, the chaos with inflation, and how far and fast can it go. And for those people like your dad and myself who were around in the late 70s and early 80s, particularly early 80s, stagflation was really difficult to deal with. Low growth and high inflation. But a lot of people fear that can happen again. So the risk factors are just so much greater. It goes back to the early basic thesis. The world is just getting riskier, and it's going to continue to get riskier. There's no reason to think that as we live in a society globally, that risks are going to diminish. There's just new risks coming all the time. None of us had ever expected a pandemic. 100 years ago, there was a pandemic,
Sure.
the Spanish flu. But you put all of these things together, it's a sequence of risks that were just totally unexpected. But the variants keep coming on COVID. So why do we think there are not going to be more variants? Probably there will be.
Sure.
So we just have to get accustomed. Risk management is just a far greater need today, and intelligent, innovative management of risk is ever more important today. That's why I do believe that the insurance industry is one of the great industries of the world. And I also think that insurance brokerage, an agency, has a unique position because of what I said earlier, the value proposition we bring.
One last question here, and then we should probably wrap it up. How do we close the knowledge gap as seasoned insurance personnel continue to retire, along with the push for specialization?
It's a great question, and it's one that we work on all the time. We got to constantly recruit new talent. We're doing that on a consistent basis. It's not only quality now, Adam, it's quantity, because the risks are getting so large, but there's just so much of it that you just need a lot more people. And right. So quantity, but we have to attract quality people. So we're working on diversity like everybody in the industry is, but we have to keep attracting young people right out of college. And we have to do a better job. But a lot of people working on this. We're working hard on it to explain to young people what a great future there is in this industry, because it's at the core of society. It's at the core of economic development. It's at the core of protection of assets. I mean, it's just fundamental to living as as we've grown accustomed to live.
Well, on that note, really appreciate you taking the time to join in the discussion. You're definitely welcome to come back at a later time. We had a bunch of other questions that we needed to that we should address. So thank you very much.
Okay, well, thanks, Adam.
Sure.